Bitcoin and Ethereum remain under pressure as the macro climate continues to deteriorate. But yesterday they sprung into life briefly, trading up around 4% and 6% respectively intraday before selling off. But the main story remains in traditional markets, with the UK remaining at the epicenter of the crisis. Cable is trading around the $1.05 mark, and gilt yields remain elevated despite falling immediately after the Bank of England stepped in with a bond buying program. The UK is now raising rates and conducting something QE-esque at the same time, which is unprecedented and pretty crazy. Heavyweight US financial commentators are issuing damning reviews of the UK's fiscal policy, suggesting that it risks creating a global crisis. And even the IMF is breaking with protocol and offering unsolicited commentary. And it's starting to sound a little bit coordinated, if we're honest. After all, the UK has the second lowest debt to GDP ratio in the G7, so it feels that the criticism is serving cross purposes. The much ignored factor in the recent volatility is the £100 billion energy cap that is set to be spread out over 2 years. Well, just days ago, Japan burned $25 billion in a failed yen intervention that was reversed within hours by the dollar wrecking ball. And the German-Italian 10-year spread continues to widen as the EU government bond market continues to deteriorate. But it's odd that most of the vocal critique is not of the borrowing, but of the tax cuts, which the OECD recommended earlier in the year. US commentators seem keen to frame the UK as being the instigator of a pending crash, deflecting attention from the damage that the Fed is doing to the global economy, and also that the US 10-year yield is at unsustainable levels at 4%. And the IMF is headed up by a former EU commissioner, and we would do well to remember their views on having a low-tax competitor on their doorstep. That said, markets are moved by imbalances between buyers and sellers, not by who's right.